All right, good. Well, fantastic. So we're going to kick straight into it. We've got a fantastic panel to really sort of talk about kind of this full investment life cycle then around kind of not just that institutional exit, but going back to that sort of beginning from even a developer perspective around how are those sort of vehicles created, right? So Peter, I am going to start with you since you've subbed in, so you might as well just get straight into the deep end. As kind of a developer, and I mean, obviously we want to hear more about sort of the news and then the story around the listing, but as development capital, looking at sort of longer timelines of institutional sort of exits, has there been a sort of structural sort of challenge where that's starting to narrow, I guess, around the ability to develop, hold for a sort of sufficient period, and then ultimately exit, particularly from a developer perspective?
Thank you and good morning. I'm Peter Mayavi. I'm sitting in for my boss, Mbae, who couldn't make it. To answer your question, Wayne, first, when did you move to Broll? I think we need to talk after this. Yeah. The thing about institutional exits for developers, it's quite interesting because I've been on both sides of this coin, where I worked for IHS, which is a fund and an institutional exit, and now I'm working for a developer. Yeah. And having both points of view is quite interesting because the institutional buyers of real estate, basically, first of all, there are a number of things that they look at for developers. Of course, being an institutional exit, Kyo is here, my former colleague. One of the criteria that they look is the kind of developer that you are, how you treat ESG, whether you can actually raise capital to do the development, and also what kind of discounts you can actually afford them. Yeah, but the one big driver of that is the systems. What systems do you have in place? You can't have, of course, a fly-by-night kind of developer. So a big part of what developers look like, because they're raising institutional capital. Sure. Yeah. So they need to reflect what the institutions that they have raised capital, what they're asking off of them. Is it green? How are they treating ESG? How are they treating land issues? Where did they get the land from? What's their exposure to things like political exposure and things like that? Sure. So those are the kind of factors I would
and I guess it probably also comes down to two magic words of prove it. Either that particular concept or having done it elsewhere successfully, right?
Exactly. Yes. You can't. One of the things, of course, is you need to be able to have proven that you can actually, deliver what this institutional buyers are looking for, and that's why, for instance, it's been quite easy for IHS to work with a developer like Mivida, because Mivida has gone out and proven that they can develop at scale, as well as people like ourselves at Centum. We've proven that we can develop at scale, and so we are recipients of institutional capital.
Yeah, so more institutional capital needs more partners with credible track records on the development side, I think.
Exactly, yeah. We've been, we as Centum are recipients of IFC capital. Right now, we are quoting other institutions, like people like AFDB have shown particular interest to work with us. IFC, we are working with them to raise a bond in the next probably 6 months or so, to raise a green bond. And the only way you're able to attract institutional capital is because of how you're set up as a developer. You can only show the systems that you have. And that's why the institutions are able to work with you.
Good. Darshan, I think your perspective is a really interesting one, because I think as this maturity happens, we need to be more sophisticated in capital structures, and the tools in our toolbox need to kind of evolve quite a bit in terms of the sort of funding model. I mean, MES or mezzanine finance, still relatively sort of new in the lexicon of a lot of real estate players across Africa. But maybe just give us some context to yourselves, but also how MES kind of fits into that capital stack, the role it plays, and how it can also sort of ultimately support more sort of institutionalized exit through that life cycle.
Thanks, Wayne. So to introduce myself, I'm Darshan. I'm an associate partner at Vantage. I cover East Africa investment activities. And here in Kenya, we have 3 investments, which I can speak about. And we have quite a bit of significant exposure in the real estate space as well as other sectors. So to your question, what is MES? Effectively, MES sits in the middle of the capital stack between senior debt and equity. So it's also priced accordingly. It's more expensive than senior debt, which is your cheapest form of capital, but ultimately significantly less expensive than equity. With equity, there's no obligation to repay it, but ultimately, with private equity players or other institutions, they end up taking a significant minority, or in many cases a majority stake, resulting in significant dilution for sponsors. I think in terms of the context for African real estate, what we see is banks generally are more risk averse. They're only willing to participate at a much later stage, depending on their risk tolerance. And sponsors, as I mentioned, don't want to take on heavy dilution especially at the early development stage. So it's more of a structural gap which MES is plugging. And what we do with we come in at that early development phase. The idea is then to bring in institutional expertise. We bring in governance, and ultimately unlock the asset for cheaper institutional capital.
Ladies and gentlemen, what I heard there is he will fund your development no matter what you... All right. No, that's great. Ruth, I think... I think we often see this kind of disconnect from developers that kind of go through this journey, and it's a sort of a period, the world changes, things happen, and there's often the kind of pricing expectation that are anchored by various factors, right? Rightly or wrongly, etc. I mean, and often, to be frank, there's a disconnect between what buyers are actually willing to pay at that point, which is ultimately a factor of a yield and an income kind of play. Right. That's less the question is, are you seeing that kind of gap closing? And what is sort of contributing to that sort of, that gap in the trajectory kind of going forward?
Thank you, Wayne. Just introduction, I know you said my name. I'm Ruth Okal. I work for ICEA Lion Asset Management. And our properties are, we in REITs, we also do direct assets for insurance and for also pension schemes. So we exist to create and protect wealth. So to your question, when I like to look at real estate value chain as a river that starts from somewhere and gets into the ocean. So the developers are at the source. They are building something that then will flow to the ocean. And as capital allocators, we sit just at the entry of the ocean. We sit between the developer and also the people that we represent, like pensioners, for example. So the question that we ask is, whatever flows through that river, when it reaches the ocean, is it bringing what we're expecting? And I think that is to rephrase your question. And a lot of times, the gap, to me, has not narrowed. It has changed shape, and at some point it has narrowed. And why do I say so? Because 3 things. Number one, we still have a lot of capital structure mismatch. As you rightfully said, we allocators of capital, we are looking at yield because we invest to get a return. So we're looking at yield, and our yield will underwrite maybe around 9-10%, but you'll find a developer getting maybe financing at 14-15%. So then what happens? Your cost of funding is about 14-15%, and you have a buyer who is looking at a yield and willing to underwrite at 9-10%. So you have that gap of about 5% that someone has to shoulder. So what happens is that now you find the developer either having to be willing to take on to sell at a discount, but that of course wipes their equity return. So there's that mismatch in terms of capital structure. The other thing is also we find that developers, some of them over leverage and some of them leverage to improve IRR. But when you come to this side, we're looking at yield. So we're not really looking at your IRR. And that becomes a problem because you're optimizing to improve your IRR and your multiples. And for this other side, we're not looking at the multiples. We're looking at, we invest money to protect our investors' money. We don't invest money to chase returns. So we are not going to be overly looking at high returns or high IRRs. For us, it's what is the cash flow. So I would say you can call it, as fund managers, we are overly boring. We want predictability. We want to see the cash flows coming in, and we want sustainability, and we want it to be long term. So it doesn't matter whether your IRR is 28% or 25%. As long as my yield, the cash flow cannot support the yield that I'm looking at, and the distribution that I will then give to the investors, it will not make sense. And I think the last is just really transparency and governance. We meet a lot of developers who have not put their house in order, and I think this has been talked about several times, even yesterday. So you come and you don't have proper titling in place, you don't have proper project documentation, you don't have proper, leases or agreements in place, and even audited accounts. You don't have those in place. So that becomes an issue. And the gap, it's a gap. But just to close, sorry, just the final thing I was about to say is that what we've seen clearly. Let me try. Yes, so what in where I said that the gap has not closed as well, and that some places the gap has widened, is because we've seen the quality of the product has really, really improved. We've seen a lot of options now in the market. Before we were in traditional assets, now we are seeing student accommodation, you're seeing cold storage, warehousing, and all this. And that is good. The product has improved. But
That's
then
great.
How do you match that gap between the capital structure and the three items I've just mentioned?
Good. And that's Ram. Ram, I guess your perspective is an interesting one in that you are a Pan-African platform across the entire continent, and you'll give a bit more context into that now through your response. But how do you sort of look at that differently in terms of ultimately a sort of exit? Of course, you can never kind of have a crystal ball to sort of exactly sort of know whether it's sort of a full platform, regional sort of, et cetera. But how do you sort of go about thinking about these factors differently to someone who is in a single country? So there's obviously different regulatory, currency factors, et cetera, that you've got to kind of contend with.
Thanks, Wayne. The important thing for us is that exit is secured at entry. And what I mean by that is one of the first questions we ask ourselves whenever we look at an investment is, well, what's the path here? Is the path an exit within the country, broader portfolio consolidation, regional sale, individual sale, strategic sale, etc. So that is built into our investment thesis. And the way we think about this is we always start by, well, is the macro perspective, whether it's currency, political environment, regulatory environment, conducive to capital entering the country and exiting the country. And it doesn't mean that necessarily we want to just, this is not a hot flow. Real estate is, by virtue of what it is going to be there for 3, 5, 7 years, 10 years at least. So we're not a trader. So that becomes important in the life cycle of the investment. The other thing we think about as a platform rather than as a single individual country base is what are we good at, and what do we need to supplement with local talent or local resources or local service providers. And I think we are good at a broad-based hotel, hospitality, a real estate asset management, and bringing in the scale in certain functional areas like sales and reservations, finance, HR, marketing. But where we are not as powerful as is things obviously that touch upon things that are related to land and regulatory and permits. That one we would seek to work with a local partner. However, that form of partnership works, right? Like where we focus on our energies is we want to be flexible to adapt to what the local environment brings. So in a place like Nairobi, you can get, or like Kenya, you can find a lot of service providers or consultants that can help you navigate this journey, and that's great. You pay them a fee, they can help you. In other places, it makes more sense to actually partner on an equity basis with someone who's there locally and who probably, even if the jurisdiction or the regulation is crystal clear, you are better off with somebody to accompany you, and has the same interests that are aligned with you. So there is no one size fits all, but you need to know what you're good at, and you need to find someone who can help you cover those gaps.
Yeah, absolutely. And I think when you think about what does maturation of the real estate sector across Africa look like, it's definitely got to be this sort of basket of different types of platforms that offer different things to investors. Broadly the same sort of story and thesis, but you don't want everything to be exactly the same in terms of platforms. Great. Peter, I'm going to come back to you and sort of ask you, I guess, a bit more broadly, if when going through a sort of a deal from a development phase to sort of putting that capital together, like where are the sort of main pain points that you're finding, and I guess, are you seeing these kind of getting smoother across East Africa in particular, and is it also differing by asset class?
The main pain points, I think, for developers, a big one is let me look at this from a perspective of housing. A big way of how we structure housing projects is, first of all, you conceptualize the project. You have, for instance, on Centum, we have land. So land is not the problem at all. We have land here in Nairobi, we have land in Vipingo, we have land in Palmarina in Uganda. So land is not the problem. So we conceptualize, come up with a concept. We have to go to the market. We test whether this concept actually has, is resonating with the market. And this is what we call the validation phase. And we have to get a pre-sales of about 30% before we are confident that the market is actually accepting this particular product. And yes, sometimes the market can come back and say this is not a product that we want. And then after that, another pain point becomes now capital. How do you now raise capital to develop this? And especially for a developer like ourselves, we want to scale. We have enough land, so we want to scale. How do we do that? Because it's very inefficient now raising capital just for one project. So it means now, and that's the reason that now informs why we are going now to, like, for instance, the capital markets to raise a bond or going to institutional funders.
Can you tell us a little bit more about that? I mean, it's obviously hot off the press on the green bond.
On the green bond. Actually, we've been working with IFC on this for the last sort of like over 6 months or so. IFC agreed to be the transaction advisors on this. And the idea actually is to bring in European fund managers to do a green bond in Africa for green housing. And we are in early talks now. We've now gotten to the point where we have the green bond framework that's already been approved. We are at the process of having the second person opinion, the SPO, process.
Okay.
We have retained Moody's to do the SPO on this, and now we are now in early talks with Amundi from France and HSBC from London to underwrite this particular bond. Yeah. So that, again, that is the pain point, because if now you want to scale as a developer, how do you do that with and no disrespect to Vantage, but how do I do that with 18% capital? Because that's what.
Well, let's ask then. Yeah, Darshan, because I think there's a good case study that you can sort of look to, and it's not necessarily East Africa.
Yes.
So it might not be sort of perfect, but Seaton Estate down in KwaZulu-Natal, where MES was quite critical in unlocking kind of bulk infrastructure for a land developer, that you could ultimately exit the MES position to senior debt.
I have
not on the equity side.
Yeah, actually, I'm very glad for Vantage. Vantage has lent to us. At the group level.
That's true.
At the group level. So I'm not. Yes, they have given us. What I'm trying to say is, Vantage capital. MES capital is quite expensive. And
sure.
Any capital for scale.
Sure.
It cannot be at that, high double-digit level.
Yeah,
that's what I'm trying to.
And I guess that's exactly, it plays its role at a point and in a particular role within that capital stack, right?
Exactly. Yes. So it does play a role. MES capital, I mean, it's usually about 15%. It could unlock a lot, and sometimes it does unlock even more senior debt, for instance, and also more equity on the equity side. Or sometimes we use MES actually to replace equity funding in some situations. Yeah. So it has its role, but now to scale, we do need a situation where capital is a bit more, for lack of a better word, achievable. I would be thinking, bond capital is actually, I think, in my view, one of the best, because we're talking maybe at most maybe 12%. It's long term. Sometimes
corporate bond,
a corporate bond, or in this case, like a green or sustainability bond as well. And at that point as well, it is. What am I trying? It's in local currency. I think that's also a big part. The fact that it's also in local currency, it means then I don't have to look for hedging instruments for that. So I think that's the kind of the pain points as a developer that I'll be going through. Other than the market exit. Which in some situations is not really, because, like, for instance, the housing deficit is really dire. So the market, if you get a good product, then the market is not the problem. But now the funding now becomes an issue.
Absolutely. Good. Well, Darshan, do you want to tell us a little bit more about that sort of Seaton Estate case study, and I guess in the context to sort of the discussion today?
Yeah, so Seaton, I think that's a very good illustration of the typical exit route for mezzanine. I think if I think about most of our transactions, 90%, 80 to 90% is through a senior debt exit, but there are instances when we need to run a sale process and exit through that mechanism, and that's more common in rest of Africa versus South Africa. I think just speaking about Seaton, itself, it's a 400-hectare residential development on the north coast of KZN. When we came in, we funded 360 million rand, and our funding was used to to construct and deliver the infrastructure services. So effectively, that helped de-risk the asset. It was also structured as a multi-phase investment. So as they progressed on their precincts, they were able to roll over funding into additional precincts. So obviously what that helped them do is improve the overall value of the 400 hectares of land, the developed value of that land, and it made it possible for senior banks to invest at the lower LTVs. So that's more common in South Africa, just given that it's a more mature market. I think the rest of Africa, as I mentioned, we do have to consider sale processes. But generally, we also structure within much tighter parameters, and we need to have stronger conviction within our structuring that over time, the business can bring its gearing down, or the project can bring its gearing down to much more conservative levels that the banks here look at.
Sure.
I think the other thing I'll mention is that we also have relationships with the South African banks. A lot of them have strategies to increase their exposure in markets like East Africa. We are invested in them, in our Kenyan assets. Banks like ABSA and Nedbank, which is also invested in Centum. And as we develop those relationships and they see us going through these assets and handing them over, I think increasingly they would form our exit route as well.
Yeah. Okay, good. Ruth, I want to come to you and ask you specifically about Fahari REIT, right? And now, of course, this is the first REIT that was listed in Kenya, and certainly one of the first across Africa. Now, that since listing, that's obviously been a journey in itself, restructuring and all sorts of things. I guess, what has kind of been some of the lessons learned along the way that incumbents and those that follow can kind of look to?
Thank you. I was hoping you don't have to ask for Harry, because I'm not sure if my boss is in the room. But I think we were privileged to have been the first to set up the first REIT, because there's been a lot of learnings, and we are grateful that we've been able to pay the school fees, and the rest of the REITs have also learned from us and probably did better. But I think I don't want to just narrow it down to Fahari, but I want to narrow it down to a sector is as good as its ecosystem. So it doesn't matter how good or how bad your structure is. If the ecosystem is not working, then the sector fails. Why do I say so? So REITs, in their very own nature, they promise liquidity, they promise transparency, they promise predictable earnings. And that is a question of the entire sector, not just one specific REIT. So what have we learned? After you've done your structure, the sector must be able to provide these three items that are promised. Let's talk about liquidity. We have 4 REITs in Kenya now. A few are coming up. One just came up and another one is about to just come up. I saw they are launching soon. If you look at the trading that has been happening in the REIT sector, it has not been a lot. So one, either because some of the counters are small, some of them are held very closely, the unit holders are holding very closely and they're not trading. And that becomes a challenge for the entire sector if liquidity cannot be achieved. The other thing is transparency, and I think this is not an issue for REITs in Kenya because our regulations are very comprehensive. And the regulator is also, has been following through. And there's a lot of, if you look at even the way we report, it's standardized. And the disclosures, it doesn't matter whether you're a small REIT or a big REIT, the disclosures are exactly the same. So the valuations must be done, you must do your distributions, you must disclose if you have anything that's outside the restriction. So I think that's not a very big issue at the REIT side. But I think transparency is an issue at the property side because in this market we still suffer from information asymmetry. And why I say that is because if you look at any typical due diligence that is being done on a property, I dare say that at least 60% of that budget is spent on verifying what the vendor has told you or what the developer has told you because information is not flowing, it's not transparent. So that is the area I think we have learned that there need to be more transparency. If someone gives you a valuation, does that number make sense? But what is also supporting that number? What are the assumptions? What are the considerations? What the justification? So those are, from transparency point of view, I think it's more on the real estate side as opposed to the REIT itself. But also then the other thing is on governance. Who is behind the whole structure, from the assets to the fund itself to all the other related parties, who service providers, trustees, and all that. So that's another lesson. And I think that governance is something that is evolving, and it will take time to get it right. But if you look at the provisions in the regulations and also what is even proposed, that is being covered. I think the last thing I just want to mention is regulation. And I'm mentioning this with a lot of caution because I've seen in the last few years we were talking about tax and the tax transparency or instability of it. I've seen proposals to at least now return the exemption of stamp duty and also when you're transferring property, and also to expand the CGT to all vendors and not just specific vendors. So I think that's a very good thing. We're just waiting for it to go through Parliament and hopefully it will pass. But having also said that, our regulations are 10 years old and more than 10 years old, and it's time to review them because now with all these lessons learned, then what next? So I think those are the three things I could share from our perspective and to the entire sector.
Well, that's actually a really good segue for the question I have for Ram, and Ruth really highlighted that sort of there's the structure and the listing, and then there's the assets, right? And now in the case of Kasada, where your assets are hospitality, they're the single sort of asset class kind of focus. There's some different versions of what hospitality is, of course. But when you think about a REIT, and you know, I had my own experience having worked for Hospitality Property Fund, a REIT that was a specialist hotel fund, and we had challenges that were well documented at the time, and despite it being a tough market for the asset class, our challenges were more on the structure sort of side. Now, you obviously are multi-jurisdiction, as we sort of touched on, but specifically in a REIT context, how do you sort of see that specialist asset class focus, in particular hospitality, playing out in a REIT kind of environment?
No, I like what Ruth said about a good sector does mean that it has a good ecosystem associated with it, and that's important. So in the case of a REIT and the hospitality sector, I think what I would like to one day convince a majority of people is that hospitality is the best kind of real estate because you get the downside protection from land and building with an upside potentially on operations. When you do commercial, when you do residential, it's quite a different risk-return profile. And what's missing in hospitality, and I'll tie it back to REITs, is that most of the ecosystem that looks at investing in hospitality is actually a real estate ecosystem looking for the kind of risk and volatility that is usually associated with commercial real estate or residential real estate, but doesn't quite appropriately fit hospitality because the operational component brings volatility on the upside and obviously on the downside, even though in the long term we can achieve the 8, 9, 10% yields that most investors are looking for. So REITs structurally, investors in REITs are looking for stability, and stability in a year-over-year situation. Hospitality can't quite deliver that. Does it mean that it's not fit for purpose? No. What it means is that you probably need to have a slightly longer time frame to weather cycles where hospitality delivers a little bit more cash flows and other times it delivers less cash flows, right? So a good structure also means that there are investors behind that understand what they're investing in, and what they're investing in with hospitality is a little bit of downside protection with good upside potential. And if we get those investors right and that mindset shift a little bit, then hospitalities can fit well into the REIT ecosystem because they're with the land component, they are adequately suited to that exit mechanism.
Because you've said such nice things about hospitality, I'm going to ask you another question.
For my sins.
Exactly. Look, if a REIT is one tool in your toolbox in terms of exiting, maybe talk us through some of the others. And of course, you are a pure kind of private equity sort of player, but now talking about REITs and all this kind of longer dated sort of capital story, but what are some of those other alternatives from an exit perspective, regardless of sector focus?
No, absolutely. Look, we love talking about platforms and the idea of building scale, but at the end of the day, like I'm a real estate private equity person, we care about returns, we care about DPI, we care about getting cash flow back to our investors in some way, shape, or form. So if REITs are the adequate mechanism to do it, we will pursue it, but each market is slightly different. And there is, when you look at Kenya in particular, this REIT mechanism is there and it's growing, but we will look at any and all avenues. It can include strategic sales to players who are in the market. Depending on the scale, also we have sold to small family offices that were looking to get into hospitality. We speak also to the larger asset managers, whether it's regional or global, insurance, pension funds, etc., who are keen to add hospitality to their portfolio as a diversifier. They're not necessarily looking at it as I can invest in government bonds for 18% or 16%, but this is a very different risk profile, especially with USD or Euro cash flows. So any and all exit mechanisms we need to evaluate and look at, and we've done all of the above. And it matters, again, at entry you ensure that the market and the ecosystem is deep enough that it has these things built in.
Great. I'm going to ask a final question to all my panelists, starting with you, Peter. If you could change one thing, structurally, regulatorily, or behaviorally, to meaningfully, I guess, improve that pathway from capital raising through to institutional sort of exit, what would it be? And it's the same question to all four of you.
Quite a number of things, but I think what comes to mind, what frustrates me as a recipient of capital or somebody who is raising capital in the market is how we, as capital raisers, are always being compared to the sovereign. Ruth, I'm looking at you. Whenever you come up with a product, you're always being compared to government paper or to the Eurobond or something like that. And I find that very unfair. Why? Because I don't have the same risk profile as the government. I can't, because I'm not a government. If it was the government of Ghana, raising a Eurobond, being compared to the government of Kenya, that's a different thing altogether. So I would want maybe the holders of capital to compare apples versus apples. That's number one.
Sure.
And then number two for me also is how long also institutional capital takes to actually materialize when you're raising capital from institutions. The life cycle for institutional capital sometimes is 36 months. And by then markets have changed. Even the product that you wanted to launch for this particular capital that you're looking for probably even is no longer relevant to the market at that time. So I wish it could be faster to turn institutional capital into something tangible and viable that we can actually use. If this is just feedback to the all holders of institutional capital. If the turnaround could be faster, I think it would be better for developers. Thank you.
Okay, good. Darshan?
I think for me it would also be regulatory change within the REIT market. If you think about there's different if I was to narrow down on some few examples around the regulatory space, I think, for example, there's the tax benefits to REITs. Those are actually tied to a listing. So what that does is it provides an incentive for sponsors to list as soon as possible to get those benefits. But I think that also has an opposing side. The negative part of that is that sponsors usually need, especially with the seed asset that's going into the REIT, they usually need 2 to 3 years to stabilize the asset, show a track record of income generating potential. Otherwise, there's a huge risk when you list it immediately. There's a risk of price erosion. And I think we have seen that in earlier REITs. back in the day, a few years ago. This was one of the core issues. Another example I can give is this D-REIT, I-REIT structure. I think when you look at best practices in other markets, usually these are under one umbrella structure. But I understand here the D-REIT and I-REIT have their own like trustees in Kenya, and in the current framework, it means double costs in terms of approval processes, which both need to run in parallel, tax issues when you transfer the asset from the D-REIT to the I-REIT. I understand in markets like Singapore, both of them fall under an umbrella structure. So when you transfer from a D-REIT to I-REIT, it's considered an internal transfer. So you don't have your normal tax issues, etc. So ultimately, I think if the framework is improved, it really helps institutional capital. There's big pools of capital with African pension funds. If you make it easier for them to invest, I think you'll see a lot more capital going into the space. And it also pushes the whole life cycle chain forward.
Great. Ruth?
So thank you. First of all, I hope I have right of reply to Mayavi here. So to everyone in the room, as locators of fund, as I mentioned, we do not invest to chase returns. We invest not to lose the client money. So that is why we'll compare my friend here with the sovereign. Because the sovereign is all of us. If the sovereign goes down, there's no country, there's no Kenya. So that is the best benchmark we use. So to your question, we might still continue comparing it with sovereign because my first point of call is not to lose client money. Everything else follows that. So to the question, if I was to change one thing, since I was going to talk about regulation and it's been talked and he said very good points, I will move to valuation. So valuation is such an important aspect, and I hope there are valuers in the room. I know most of them are in Mombasa now for a conference. But valuation is so important. And why is it very important? Because if you look at a REIT, just even from regulatory perspective, a minimum of 75% of your assets are in real estate. Most REITs are way above that, 80, 90%. So if anything goes wrong with valuation, real estate valuation, because the rest of the asset classes, cash or deposits, those are 1 shilling to 1 shilling. There's no variance in valuation. If anything goes wrong in valuation and 80% of your assets are in real estate, and you have to do, for example, a write-down, you can imagine what that does to the performance of the fund, to your net asset value, to your everything. So from where I sit, if I cannot put a value to it, and that value is not transparent, is not verifiable, is not justifiable, is not disclosed, then there's no point investing in it. And that's where we have a big problem with even vendors, because someone will come and tell you my property is worth 3 billion. Then you start to do the due diligence to see how this 3 billion is coming up, and you can only achieve 1.5. So you're asking this person, I need a 50% discount, and that is where the deal it kills the deal. So valuation must be verifiable, it must be done annually, and it must be disclosed. We should stop these things of disclaimers, 3 pages of disclaimers in valuation reports. It must be verifiable, it must be done annually, and it must be supported by the property and the cash flows. That's one thing I would change.
And I would add in an ecosystem of responsibility, not just valuers, auditors, fund managers, etc., have a fiduciary duty around that. Ram, final points?
Sure. I think there's been a lot of good points mentioned already. What I would add is the one thing I would like to change is mindset. And there's a couple of things within the mindset, but one you mentioned in your presentation at the beginning, there is $400 billion of pension fund capital. This is only pension fund. This includes obviously insurance and the whole alternative space, mostly tied up into government bonds. And again, we made the point about government bonds, but what if there was a better allocation spent on alternatives? And it doesn't have to be very much, but you're ensuring the future of the country's population, which is very young, by more appropriately linking it to things that eventually can grow and generate substantial alpha. So there's a mindset shift that has to change there. And the second piece about the mindset is about scale. We mentioned again and again scale. And scale isn't vanity. Scale creates the opportunity for innovation, for adding jobs, for employment, and for creating really this. We should encourage the creation of regional Pan-African champions. We should step away a little bit from sometimes the conversations about let's diversify. We don't want companies that are too big because we get scared of what they do. But the reality is the people that achieve scale are the ones who can really invest, take risk, innovate, which ultimately brings jobs and a better life for people. So that mindset, to me, that's quite important, that we shouldn't be afraid so much of it and embrace it a little bit more.
Look, final comments, and just thanks to the panel, but I think that sovereign story is an important one, and we've touched on it, and as real estate, we need to better sell what we're offering. There's covenant, there's income growth, there's what Ram's talking about, the impact and a sort of broader story, there's the ability to leverage it. But we've also got to be mindful that, as people's money and pensions and that needs to be sort of looked after, and these returns are attractive. But the point I would make there is that sovereign risk layer, as these countries mature and evolve, ultimately will come down, so that yield will be far more competitive as we go with each year that passes, etc., and these economies mature. So it's both sides of the equation we've got to watch, and I think definitely the side we can control is that the real estate side and the story and the platforms to attract that capital into. So thank you very much to my panelists. I thought that was really good and interesting. Thank you. That's it. Thank you.